I don't have much of a voice, but hopefully the microphone will do the job. I am the Deputy Dean of the Wharton School, and my name is Mike Gibbons. And I get to do this afternoon something that is one of my favorite jobs, which is having the opportunity to welcome back one of our alums, and who will speak to us about share with us some of his experiences. And of course, who I'm referring to today is Howard Marks. Now, most of you probably know, or otherwise you wouldn't be here, that Howard is the director and the co-chair of Oaktree Capital. What you may not know is all the activities of Howard outside of Oaktree Capital. He's been involved in many charitable activities. He worked as a member of the Board of Trustees at the University of Pennsylvania for approximately 10 years. While in that capacity, he was the chair oversight of the investment committee. He's now an emeritus board member, and he's given generously to Penn in the form of either the Writing Center on Penn's campus, or the various scholarships, or chairs for faculty members. But more relevant for today is that Howard funded this investment series that we're going to hear from him. And we created a title for the investment series that was very creative. It's the Howard Marks Investor Series. So, and the series has provided a great opportunity for Wharton faculty and Wharton students to hear from very distinguished and high-profile investors that come to campus for this very talk. And it's a remarkable opportunity for our students to hear from them, and now today to hear from him. Of course, he's been involved in other kinds of philanthropic activity. He's a trustee and chair of the investment committee for the Metropolitan Museum of Art, and he chairs the investment committee for the Royal Drawing Society. While Howard has been here before, our format is maybe slightly different than usual. It's going to be more of a fireside chat, despite the fact that we don't seem to have a fire. And he will be joined today by our own Chris Geczy, who is a faculty member at Wharton, and he's been here, more than 20 years? I think I helped hire you. And yet I'm younger than you. Chris is also the academic director of the Wharton Wealth Management Initiative, and he's the academic director of the Jacobs Levy Equity Management Center. And with that, we should welcome Howard and Chris.
Thanks, boss. Thanks, Deputy Dean Gibbons. It's my pleasure to add a welcome to Dean Gibbons, welcome to Howard, and to welcome back home to the latest installment of the Howard Marks Investor Series. Howard's generous gift in 2014 established this series, and in the years since it's brought, as Mike said, many well-known and prominent names to campus to talk about various elements, ideas, experiences, and how they think as investors, including Stan Druckenmiller, Bruce Karsh, Seth Klarman, Stephen Schwartzman, and of course, Howard himself, among others. I'm sure most in the audience are familiar with Oaktree Capital Management as the most well-known manager of distressed debt in the world, since the firm was founded by Howard and Bruce and colleagues in 1995. Howard's been responsible for steering investment philosophy and communicating closely with clients, often through his famous Oaktree Memos, about which I'm going to say a few things. 3 of these memos, as most of you know, in particular, will inform our discussion today. As many of you know, recently Brookfield Asset Management acquired a significant stake in Oaktree, and the 2 companies have just under $500 billion in assets under management. In the memo, Dare to be Great 2, Howard revisited a previous memo on how institutional investors might approach the goal of achieving superior investment results, exploring the risks that can be necessary in order to outperform the market. In another, Risk Revisited Again, we find a compilation of Howard's writings and insights on the subject of risk, including how to cope with uncertainty and anticipate different outcomes. In his most recent memo, You Bet, he examines the connection between investing and gambling, outlining the ways in which hidden information, luck, and skill can be important factors in both. All of Howard's memos, which he's written quarterly since 1990, Mike, I graduated in 1990, so this is a serious history of writing, are available in the archives on Oaktree's website. I encourage everyone here to explore them further as they delve into many of the real-world questions and decisions you'll soon encounter in your professional lives. They're required reading, in my view, and if you take my investments class, you'll read Marx. Howard's knowledge and experience in the investing world are truly invaluable, not unlike his contributions to Wharton and Penn through the years. If we recounted them all, we'd miss the main event. So I'll just give you a TLDR version. In addition to the speaker series, Howard provided foundational support for the Wharton Business Radio on Sirius XM. He endowed the Marx Family Writing Center, which focuses on helping Penn students and faculty across disciplines become better writers. Some of you, I suspect, have availed of yourself of the opportunities held there. He and his wife established a chair in economic history, and we're fortunate to have Mark Flandreau, the Howard Marks Professor of Economic History, with us today. In addition, Howard is a trustee emeritus of the university and formerly served as chair of Penn's investment board. Again, I'm only touching on the surface of Howard's deep commitment to our school and to the learning process here. Howard, thank you once again for your passionate support of Wharton and Penn and for all you continue to do. And I think we should get going.
Sure. Great.
So, the format for today, again, as many of you know, will involve a number of students who have been selected in a quasi-random way to represent a diversity of opinions, views, and questions. And we'll ask those students to come up front. I'd like to start off, though, by asking you directly about the memos. What was the story behind the memos? How did they arrive? They're famous in the world of investing, and that's both in academia and in the outside. Where do they come from?
Well, number one, since I started back in 1990, it's hard to remember why. But I think that the answer is that I came across 2 events, both of which were separately interesting, but the juxtaposition of the 2 I thought was really important. One was I met an investor who had invested steadily and had good but not spectacular results for 14 years in a row, and as a consequence was up to the top in his peer group, and then an organization that had a horrible year because they shot for the top and ended up at the bottom. And I thought that the juxtaposition of those 2 experiences told you an important lesson. So I wrote that first memo. I can tell you I didn't do it to get famous. I didn't do it with the expectation that anybody would ever read them, but I did it because I had something I wanted to say. And the other thing is that, when I was here at Wharton in the 60s, we were required to have a non-business concentration. And I took, for another reason I can't remember, I took Japanese studies as my minor, and the professor was very stringent on writing, and I think that lifted the quality of my writing. So, and I do it for pleasure. There was a rock club called the Fillmore, and it was run by a guy named Bill Graham, and he said he's famous for saying it's only work if you'd rather be doing something else. So if you look at the memos, there's usually one published in January, meaning I wrote it on Christmas vacation, and one published in September, which means I wrote it over the summer, because it's a way I like to spend time. I'll just add that in the first 10 years, I never had a response. Not one. And the interesting question is what kept me going, and that I certainly don't remember. But not only did nobody ever say that was a good memo, nobody ever said they got it. Now, these were the days when we used to fold them up and put them in envelopes with stamps. And they only went to the Oak Tree clientele, so it was a narrow group. And to respond in the old days took some effort. You had to either write a note and mail it out, or you had to actually pick up the phone. It's not like now. But anyway, that was the first 10 years, and the last 20 years have been very gratifying. And I think we went from sending it out to 300 clients at the beginning to a mailing list of about 100,000 now.
What's your creative process like when you write the memo? If you study the way people create, the way they execute their art and their science, there's a great diversity of approaches. What's your personal approach?
Well, I mean, I think that first of all, it varies. They don't all have the same genesis. But I think that one of the things that I do is I see, like I did in that first memo, I see diverse things and see a pattern in them. And maybe it's a pattern other people don't see, so I write to call it to their attention. And so I just pile up snippets, I pile up clippings, I pile up quotations and so forth. And when it reaches critical mass, and I write the memo. And, the one on gambling, which just went out last month, I started in June and finished in January because of a lot of other things that had more time sensitivity came in between, and I've done them in a day. The day after Lehman Brothers went bankrupt in 2008, I got one out the next day. So, some of them are literary excursions, and some of them are pressing business.
And do you get feedback today?
You get feedback, yeah. And interestingly, the one on gambling was the second. I got the second most feedback on in history, and the only one that exceeded it was one called "Getting Lucky," about the role of luck. I hasten to say, not in the campus sense, from January of 2014. And I think what they had in common is that in both I told my own personal story. In the luck one, I think I've been, I'm a believer in luck. I think I've been fabulously lucky in my life, and I'm not hesitant to say it. I don't claim it was all my own doing or skill, so I put a lot of that into the memo, and people like that. And then in the one on gambling, I spent a page or two on my history as a gambler, and people enjoyed that. So people like the personal side.
Nice, good. So we're going to ask the first student to come up and ask a question and hear the response and maybe ask a follow-on. I'd first like to ask Leek Deng to come up to the podium. Leek's an MBA student with a concentration in finance, scheduled to graduate in 2020.
10 weeks.
But who's counting?
So thanks again for coming to speak with us. So in your memo, Risk Revisited again, and in your book, the most important things illuminated, in which you dedicate actually 3 chapters to recognizing, understanding, and controlling risk, is very clear that risk is the most essential aspect of investing. So my question is, if risk is invisible and it exists only in the future and it's impossible to know for sure what the future holds, so what are some of the qualitative tools, practices, or systems in addition to lack of hubris, as you mentioned, and knowing what you don't know? What are some of those tools and systems that students like us who may be just beginning to dabble in investing should start to explore to better understand, control, and recognize risk?
Well, I think the most important thing, Leek, and thank you for that good question, is to understand the nature of what you're engaged in. And, if you like quantitative processes that consistently produce a successful decision, then I would advise you not to become an investor. Because our job is to deal with uncertainty. And at the start of the memo on gambling, which just went out, I tell the story of the first book I read here at Wharton in 1963, which was entitled Decision Making Under Uncertainty in the Oil and Gas Industry. It's a fascinating topic. But the point is, that's our job. We do not, there's no certainty. I hesitate to describe what we do as even a process. I mean, we have a process, but it's conjecture, it's judgment. It all comes down to judgment. John Kenneth Galbraith said that there's nothing dependable to be learned about making money. If there were, the study would be intense and everybody with a positive IQ would be rich. Everybody wants to make money. And if there were a surefire mechanical process for doing so, then number one, it would become widespread in its use, and then, of course, it would stop working because we make money by outthinking others. So, I have to disappoint you. I can't give you a process. But, we have to understand that it comes down to judgment, that our judgment is imperfect, that our job is to deal with uncertainty. What investing has in common with gambling, hopefully in addition to skill, is number one, there is hidden information. There's stuff we don't know that we'd like to know. And number two, there's randomness because we don't know what events are coming next. And so all I can do is say that, if you are good at making judgments under uncertainty, if you can think about life probabilistically, if you can have a sense for what you know and a sense for what you don't know and its importance, then I think you can become a good investor. There's a very good book called Fooled by Randomness by Nassim Nicholas Taleb, and he contrasts investing with dentistry because he says the dentist goes to dental school, and if he learns how to fill a tooth, he can successfully fill the tooth every time. There's no randomness in dentistry, and as a consequence, there's almost universal success. But in our world, we deal with the unknown. We step into the unknown all the time, as Peter Bernstein says. And so our job is to deal with fractional information and make judgments.
Howard, I'd like to ask a little bit about how you coach and motivate expert investors. And so Lee's question, I thought, was one that your answer really focused on for new investors and maybe experienced investors alike. But when you're dealing with a group of extremely talented, experienced investors who have their own biases, how do you manage them? And this reminds me of what you said a couple of years ago when I asked you about leadership. I asked Howard what the most important thing about leading a team is, and his answer was selection. What are your thoughts are?
Well, look, we do selection is extremely important. It's hard to make people into something they're not. We always say we look for the best athlete. We hire people who haven't necessarily done before the things we want them to do, so they don't have a record we can assess. But we look for personal attributes, judgment, consistent thinking in terms of process, and covering the bases. One of the great conundrums in investing is that if you don't have belief in yourself, you won't be able to take strong enough stances to overweight some securities and underweight others and exclude others and bet heavily on the ones you think are great and less heavily on the ones you think are only okay. You have to have a belief in yourself. But if it's excessive, if it's hubris, then you're going to, if you make a mistake, you're going to follow it all the way down, and a small mistake turns into a disaster. So, all we can do is make judgments about the intelligence and discipline of the people we're interviewing and of their ability to think probabilistically and live with the uncertainty that comes with operating in a probabilistic world. I think you're the one who said we live in the sample, not the universe, right? That's right. And it's very important. Peter Bernstein, who I cited, it was Elroy Dimson, said, risk means more things can happen than will happen. There are many possibilities as to each of the phenomena that will affect us. Only one will happen, the sample. The universe is much broader, and we have to be able to live with thinking that way. Now, what do we do for coaching? We try to encourage them to think broadly, to consider the things they know, to consider the things they don't know, to point out the things that they've missed, to explore any glitches in their thinking, at the same time bearing in mind that we don't know everything. So, my thinking isn't perfect either, and my senior colleagues. So it really is collegial, and we try to encourage people to express their opinions, even if they're not absolutely right, because nobody's ever absolutely right.
Yeah, before our time today up front, we had a meeting with students, and Kenny, one of the folks who was there, asked you about resilience. And I also remember that one time in a conversation you mentioned that one of the most important personal characteristics of long-term successful investors is the ability to be dispassionate. And yet grit is defined as passion plus perseverance. How do you distinguish?
Well, you have to keep at it. You can't let one failure knock you off. You have, the greatest hitter in history, I guess, was Ted Williams, and he was out 60% of the time. So, you just can't, you have to be reasonable. You have to go into a field that is appropriate for your characteristics. So if you can't live with failure, you should become a dentist. If you can live with a little failure, you could be a bond investor. If you can live with a bit more failure, you can buy stocks. And if you're okay with failing 80% of the time, you can become a venture capitalist and look for a unicorn. But, we all have to live with some degree of failure in our lives. And anybody who is, I can't make a mistake, it would kill me to make a mistake, you're destined for an unhappy life. Because nobody can function without making mistakes. And I think it was Wayne Gretzky who said, you miss every shot you don't take. You have to take a bunch of shots. You shouldn't expect them all to score, but you have to keep shooting.
Thanks. Jing Zhang is an MBA student with concentrations in business analytics as well as entrepreneurship and innovation for the class of 2020. She couldn't be here, but she submitted a question I'd like to ask you. How has your investing style or styles evolved over time? And can you relay any big lessons that you've learned along the way?
Well, I think that, I was very fortunate because I spent my first 9 years, I went to Citibank out of graduate school in '69, and I spent the first 9 years in equities. And that was a disaster. So the good news is I didn't get canned, and I was asked to move into the bond department and start a convertible bond fund, and then shortly after that, a high-yield bond fund. And that played to my strength of caution and looking out for the potholes, and able to hit a high batting average with few disappointments. So that was a good fit between my strengths and the job description. Over time, Oaktree evolved from bond investing to other fields which I describe as more aspirational. So in distressed debt or real estate or private equity or emerging market investing or infrastructure investing, we take bigger risks with an expectation of a lower batting average in the hope of higher returns. Of course, that required an adjustment. If in high-yield bond investing for 42 years, our batting average has been about 99%. We've had about a 1% default rate. But as you move into things where you're trying for a return of 10%, 15%, 20%, 25%, you can't expect the same batting average, and you have to adjust. I would honestly say that the more aggressive forms of investing are not as consistent with my own makeup. And I've partnered with people or hired people who supplied some of that aggressiveness. And, as we sit here in 2020, this is a tough time to ask me that question. Because, since the end of the global financial crisis, the stock market hit its low in March of 2009. So next month it'll be 11 years. And the markets have essentially gone straight up for 11 years. Our business model is predicated on there being cycles. And we think we're extremely good, in particular, of taking advantage of the negative part of the cycle, the distressed debt, the distressed mortgages, and so forth. And so that essentially hasn't worked for the last 11 years. The world has not presented us with those opportunities. So in the last 11 years, rather than being cautious and waiting for the downturn, we would have been more successful if we'd been aggressive and profit from the upturn. That's an important lesson that I've learned myself.
Another Howard Marks phrase, we collect them around here, is being early is sometimes observationally equivalent to being wrong. Right. And at a previous incarnation of the series, you were talking about the distinction, maybe it's not a question of being in the 7th out of 9 innings, but being in the 8th of 14.
Well, that's the point. Back in 2008, when we had the global financial crisis, people got into the habit of saying, what inning are we in? And what they meant is, when is the pain going to stop? I mean, 2008 was, especially the last quarter, was an incredible meltdown. And it seems funny to be sitting here talking about it, but the point is, people actually thought that the world financial system was going to melt down. And by the way, and the people who thought that, nobody could tell them they were crazy, because we saw Bear Stearns disappear, and Merrill Lynch be absorbed, and Wachovia Bank and Washington Mutual went under, and then Lehman Brothers went bankrupt. So, and by the way, Morgan Stanley was next, and Goldman was right after that. And if this downward spiral hadn't been arrested, it would have happened. And we've had to, stand up when we thought we were right. If you're 100% sure you're right in the face of all the evidence to the contrary, then you're cocksure, and that's not a great idea. But you have to be, as I said before, you have to have enough belief in yourself that you can invest when nobody else does. Of course, that's when you make the big money. If you can invest when nobody else is optimistic, then clearly if there's no optimism abroad, then the prices of the assets you're buying will be tremendously low. That's when you make the big money, but it's not easy. And Dave Swenson, who runs the endowment at Yale and has done a fabulous job for about 33 years or something, has a book out, and he says that investment management requires the adoption of uncomfortably idiosyncratic positions, which is a beautiful phrase, just those two words, uncomfortably idiosyncratic. If you don't behave differently from others, you can't expect to outperform. They say that the definition of insanity is doing the same thing over again and expecting a different outcome. By the same standard, it would be insane to think that you can have the same behavior as others and outperform them. That's an oxymoron. So if your goal is to be an outperformer, which if you're in investment management and your goal isn't to outperform, you're wasting your time. But if outperformance is your goal, you have to behave differently from others, and it's often uncomfortable. You have to not buy the things they're buying. You have to buy things that they think are valueless. And by the way, if it's when everybody believes something's valueless that you get it at a low price. You have to do the things others don't want to do. But number one, it's uncomfortable because you're in the minority. And number two, even if you're right, it'll take a good while for it to work. So the way a non-professor would say that is that being too far ahead of your time is indistinguishable from being wrong. And you have to be able to live with that. And I've lived with that plenty.
Yeah, I get it. To exercise this concept a little bit more deeply, I'd like to invite Elnur Aliyev up. Elnur is a student in the Lauder program, earning an MBA with concentrations in finance and a master's in international studies, and is also in the class of 2020.
Yeah. Mr. Marks, thank you for coming down to campus. It means a lot to me personally, and I'm sure to my fellow classmates. My question is about economic downturns and investment opportunities. You briefly touched upon it. So in your book, the most important thing, you mentioned that economic downturns create some of the best investment opportunities. So far, investors have bought every dip in the markets. With markets flush with liquidity and private equity dry powder in record levels, how do you envision the next downturn with regards to contrarian investment opportunities? Thank you.
Yeah, well, that's a great question. He alluded to my first book, which is called The Most Important Thing, still for sale, by the way. And my second book, which came out about a year and a half ago, was called Mastering the Market Cycle. And, you know, I'm a student of cycles. I've lived through half a dozen important cycles over my career. I believe there will always be cycles because people, what are markets, what are economies? They're a bunch of people making decisions. And I believe that people will always go to excess. And as long as they do, economies will get overbuilt and then go into a period of idleness. Markets will become excessively priced and then go into a correction. So that's my belief. Now, as I said a couple of minutes ago, we've had 11 years without a downturn, pretty much straight up. Longest expansion, economic expansion in history, longest bull market in history. And when you get into the late innings of an upcycle, especially an upcycle, what do people start saying? Maybe there'll never be a down cycle. Maybe there'll never be a correction. Maybe this time is different. In the past, excesses have been led to corrections, and bull markets have led to bear markets, and bubbles have led to crashes, but maybe not this time. And and by the way, there are people who are saying that today. The longer we go, the more they're prone to say it. So nobody says it in the first inning, in the first up year. Nobody says, well, maybe it's going to go 12. But in the fifth year, maybe they say it could go 13. And in the eighth year, they say this could go 16. And in the 11th year, they say maybe there'll never be a downturn. So by definition, if you think about it, the later we are in the upcycle, and ostensibly the closer we are to the downturn, the more likely they are to say there'll never be a downturn, or at least that it'll come later. And the only thing I can add to that is so far I can't prove them wrong. So, you know, for example, in the U.S., there's never been an economic expansion of more than 10 years. And now we're in the 11th. So now people are starting to say, well, what about Australia? Australia's in the 29th year without a recession. So maybe the U.S. will go 29 years, which means that the distress investor and the person who likes to profit from crashes isn't going to have any opportunities for another 18 years. You can't rule it out. But you can look at the differences between the U.S. and Australia, for example, and conclude that what has happened to them is not relevant to us. I believe we'll have a downturn, but right now, everybody's made money. Money's really cheap. Everybody who has money is eager to put it to work. If you bought the dips in the last 11 years, you made money. Every problem's been corrected. A couple of months ago, we assassinated that Iraqi general the Iranian general in Iraq, and the market had a terrible day, came back the next day. 2 weeks ago, when the coronavirus started to worry people, we had a terrible day, came back. So what's the lesson? The lesson is, whenever there's a dip, it comes back. My guess is one day we'll have a dip that keeps going south, but I can't prove it yet. And, that's why Chris is right. We keep coming back to the fact that being too far ahead of your time is indistinguishable from being wrong. And so I believe there will be cycles. I believe we're, in some sense, primed for one, in other ways not, but in some sense. And the next question is, when you believe something, and this goes to what I said before about confidence but not hubris, when you believe something, how heavily will you bet on it? And if we would have bet last year that it can't go more than 10, we'd probably be out of business this year. So you can't bet too heavily on the things with regard to which you might be wrong.
Howard, under your leadership, Oaktree has been a harbinger of different kinds of innovation and expansions of business. I've read recently about some of your activities in Italy, and recently about what you're doing in China. To ask you a question about the boundaries of Oaktree's view, I'd like to ask Snigdha Srinadani. Did I get it close? Excellent, thank you. To come up. Snigdha is an MBA student with concentrations in business analytics and finance, and once again, she's of the class of 2020.
Yes, thank you very much for taking the time to join us. For very obvious reasons, my question has some inclination to emerging markets. So my question is, while most of the funds are now looking at emerging markets, and there is some reasonable implication of cycles in those markets, how would an investor consider the factors like low transparency, unreliable regulatory and political climate, etc., into making those decisions?
Well, thank you, Snigdha. It's nice to see you here. We met in the class, October? Yes. Yeah. Well, there are similarities. We're value investors. We look for value everywhere. We believe that value investing can be practiced any place on the globe. And we have a process to try to figure out basically what future cash flows will be and value them in the present, applying a distribution approach. On the other hand, it's extremely important to be cognizant of the differences. And there are many differences. First of all, regulation, transparency, quality of accounting. I remember back in '98 we invested in an Argentine shoe manufacturer called Alpargatas, and it turned out that the books were wrong. Now, as an investor, you have little opportunity to do anything other than invest on the basis of the accounting. Well, what if the accounting is fraudulent? There's almost nothing you can do about fraud. That's number one. Number two, the emerging market economies are in large part derivative of ours. For decades, they have risen and fallen with the demand from the developed countries, but in an exaggerated fashion. So you have to be on the lookout for that. On the third hand, they are developing their own consumer class, and at some point in time, the indigenous consumer class will take over from the export markets in terms of importance. And as the middle class begins to consume and begins to want and achieve a higher standard of living with more consumption, that'll be a source of growth from which one can profit if you see it right. Number four, however, we started in emerging markets 22 years ago in equities because there wasn't much debt, much corporate debt. It was basically not a leveraged economy, the emerging markets, in large part because they couldn't get credit. Then coming into the 21st century, they could get credit, and they started to borrow. And then since the global financial crisis, when so many people have so much money and they're trying to get rid of their money, they're trying to place their money, their standards have declined, and now it's easy, or I should say not now, well, maybe now, but it became easy for corporations to borrow in the emerging markets. And in order to make it easy to place their debt, they borrowed in dollars. Because if you buy a debt of a foreign company and you lend them dollars and they're going to pay you back dollars, then you don't have to worry about what happens to exchange. The only problem is if the demand from the developed world declines, where are they going to get the dollars to pay you back? And we believe that a lot of companies and countries have too much dollar-denominated debt. I'm only going through these things to show you all these considerations. And you can't say, what was it? Married with Children. The guy says, well, I don't know if I can tell this joke here. But his wife,
we are on tape.
But his wife's expecting, and he says, sex is just like Canada. We know it's just over there, but we never go there. The point is that the emerging markets, is that okay? Can I say that?
It's done.
The point is that the emerging markets are not just the same, and so you want to apply a rigorous value approach, which is similar to what we do here, but you also have to take the peculiarities into consideration.
Is Anil Lakala Ayat here? Anil, are you here? Yeah, why don't you come on down? Just come on down. We didn't see that you checked in, but you earned a right to ask a question. So, do we have a microphone that could go to Anil? We can have him come down.
He'll be down in a second.
Yeah.
Hey, so yeah.
Be like Drake and walk with the mic. It's all good.
So yeah, thanks for coming and doing this. Really appreciate it. Yeah, really a fan of of what you've done in the past, and appreciate the memos and everything. So my question is about I previously worked in investment management, and there seemed to be a feeling among the investor community that the markets were getting more efficient over time. This was particularly observed for blue chip stocks, so like the Apples and Googles of the world. Every model was there was basically no way to find some different perspective in some of these larger stocks, and it seemed to be seeping through into the middle bracket stocks as well. Do you feel that with the information age and the internet and the easy access to data and new information that the market has been more efficient over time, at least in the U.S. or developed markets?
Thank you for that question, Neil. When I was at Wharton, I don't know too much about what it is now, but when I was at Wharton, it was entirely qualitative and practical. And then I went to University of Chicago for a master's, which was entirely quantitative and theoretical. And in particular, I was taught there something called the efficient market hypothesis, which basically says that there are so many people trying to make money, and they're all intelligent, computer literate, they have access to data, they're highly motivated, hardworking, rational, and objective. their combined efforts drive out the bargains. And if a market is efficient, which means that it meets that description, then you would think that you can't find a free lunch there. You can't find bargains. You can't find things that are priced so low that they offer a very high return without commensurate risk. That's essentially the efficient market hypothesis. And that the market efficiently incorporates new information to maintain that condition. That's the ideal world according to the University of Chicago. Now, the good news is that for me, it wasn't always true. So in 1978, when I was asked to start a high-yield bond fund, for example, number one, 90-odd% of all investing organizations had a rule against buying bonds that were rated below investment grade. And they were called junk bonds, which was not a reassuring title. And Moody's defined a B-rated bond as fails to possess the characteristics of a desirable investment. In other words, you could not prudently invest in a non-investment grade bond. And so if you did invest in that, you took the risk of being wrong in an embarrassing way. So these are biases in a market. And if you go into a market, remember that in the description of the things that made a market objective, among them were that every investor is rational and objective. But if you have things in markets that make people non-objective, like a bias, that a B-rated bond can't be a good investment, then somebody without that bias might be able to go into that market and find a bargain. And so I was lucky because I found it in high-yield bonds in 78. I found it in distressed debt investing in 88. So remember I mentioned the memo about luck, getting lucky, January 14. So in the second half of the memo, I tell the story about this kid who wants to become a better poker player. So he works really hard at learning the odds that a certain hand will be successful, learning the odds that he'll get the cards he needs to complete a certain hand, studying other players for their tells, the little things that show when they're bluffing, etc. And he's working really hard, and his uncle takes him aside, and he says, you're wasting your time trying to become a better player. Why don't you just look for an easier game? Inefficient markets are easy games because they're not picked over. And so if you are willing to do the picking, you can find exceptional purchases. They shouldn't exist. There should not be exceptional profit opportunities without commensurate risk. The theory tells us that, and it makes sense. But sometimes there are, and I benefited from. Okay. So, and I try not to stretch out this answer too long, but I find it one of the most interesting questions. The point is, when I got out of school 50 years ago, the world was a dumb place. There was so much we didn't know. Nobody had a computer. Believe it or not, when I got out of school, nobody had a calculator. Nobody had a calculator. And if you invested $11 today and you sold it for $28 in 5 years, there was no way to compute what the compound growth rate was, other than trial and error. Well, try 11%. So really, the world was a stupid place, and people had biases. And there's nothing that creates a misvaluation better than a bias. And by the way, when I started in high-yield bonds in 78, people would say to me, well, young man, I'm sure you could make money doing that, but it wouldn't be proper, investing in junk bonds. Fast forward to 2020. Nobody says that anymore. Everybody says, if you can make money, I'll do it. And, the world is now a much smarter place. There's no such thing anymore as not knowing something. Everybody has information to all the access to all the information. We sit at dinner We talk about, who was the greatest hockey player in history. Within 10 seconds. And everybody has access to all the information, and everybody's spreadsheets look the same. And the SEC makes sure, by the way, when I started, there was no regulation, FD, that made sure that every investor had the same information. Companies would tell their favorite investors stuff they wouldn't tell the public. So clearly, the access to information and the ability to process information is much more uniform today than it used to be. I would say most of the biases are gone, so there is much less reason to expect to be able to find bargains today than there was 50 years ago. The world's a smarter place. And I suggest you read that memo, at least the second half, Getting Lucky, from January 2014. And what I say at the end of that is that I believe that the markets have undergone a process called efficientization, in which the glitches, what the academics call the inefficiencies and what I call mistakes, are less prevalent and quicker to be taken advantage of. So 50 years ago, I believe it was possible to make more return with less risk. Then it became possible to make more return with the same risk, which is still a great accomplishment. Then it became possible to make a high return with low risk, which is still something. And, over time, the probability of beating the market has declined, and the margin of superiority has narrowed. And if you think about it, knowledge is cumulative. And there is no reason to think that markets will not become more intelligent, which is to say more efficient. So thank you.
Howard, has that impacted how you think about the size of your firm? I mean, one of the dominant ways of thinking today about inefficiencies is that, inefficiencies have to exist.
Yeah,
it's
sure.
the efficiency paradox,
Yeah.
because someone has to get paid to make them efficient. But then firms will grow, if they do have an advantage, just to the point at which the efficiency goes away. So do you think about how to monitor and manage the boundaries of your organization?
Sure. There should be expected to be a relationship between the amount of money you manage and the ability to beat the market, or the margin by which you can beat the market. And, the truth about our business, which you won't read in the ads, is that good performance brings more money to manage. More money, if allowed to go unchecked, brings bad performance. You can't do as good a job with a lot of money as you used to do with a little money. Now, we talk about inefficiencies, and everybody's looking for an opportunity to make a return with risk that is less than commensurate. And that is the definition of an inefficiency. It is an oxymoron to say that I have found an inefficient market niche which is infinitely scalable. I mean, because one of the things that permits the existence of inefficiencies is smallness. You can find a little area with one stock that you can put a little money into, and it happens to be a stock that nobody else has figured out. So you can get an advantage. But you may not be able to put 100 million, you certainly can't put $1 billion, and we absolutely can't put 10 billion. That's the way it goes. So that means that every manager, if they want to outbeat the market, if they want to find these special opportunities, by definition has to limit the amount of capital they take. You can't say, I can take all the capital in the world and still beat the market. If you have all the capital in the world, then on average you're going to do average. So you have to limit the capital. And that introduces a tension, because for the most part, the more capital you have, the higher your fees will be. The less capital you have, arguably, the better job you can do for your clients. So that's a conflict of interest, if you will, between the manager and the client. And you have to, one of the most important things in life is to acquit your conflicts of interest I think, in favor of the client. We've always tried to make these decisions in favor of the client, not ourselves, in the thought that if we put our interests secondary in the short run, we will do very well in the long run. If we put ourselves ahead of the client in the short run, in the long run, we'll go to hell. And at Goldman Sachs, they use a term, long-term greedy. If you're greedy in the short run, you're probably not going to do the right thing by the client and thus succeed. But if you're not too greedy in the short run, then you can do extremely well in the long run. And I think that's right. And that especially applies to scale. And I'm very proud to say we haven't increased our assets in the last 5 years. It's an easy time to raise money, but since everybody's trying to plow money into the markets, it's not a good time to put it to work. And so we haven't increased our assets. Now, here's an interesting question, though. How do you figure out where your limit is? You're in a market, you're doing well, you're getting more money from your clients in recognition of your good performance. Where do you stop? Where's the limit on how much you can take? Well, if you're Goodyear and you develop a new tire, how do you find out how far it'll go? You put it on a car and you run it until it blows up. We can't do that. We can't keep taking money until our performance falls apart because we're talking about our clients' money. We're talking about our reputation. So we have to stop before we hit the wall. If you stop before you hit the wall, then what? Then you never really find out where the wall is. But we have to err on the side of taking too little money, because if we err on the side of taking too much money, then there goes our reputation for doing a good job.
So the role of judgment is key.
It's all judgment. You know, I wrote when I was working on my first book, The Most Important Thing, still in the bookstores, I was talking about it to Charlie Munger, whose office is in the next building from mine in downtown LA. And when I get up to go to lunch, he says, just remember, none of this is meant to be easy. Anybody who thinks it's easy is stupid. And that's half of what you have to know. I mean, it's a competitive business where the goal is to make money. Can't be easy to outperform the other person, by definition. So that's what we have to try to do, but we have to understand our limitations.
Let's have another question. We're pushing time a little bit, but I think this is an important one. Let's ask Carlos Alcazar. Carlos, are you here? Carlos was here. You checked in. No, there you are. Coming up, Carlos, with a question on specifically on judgment and how you rely on background and combined.
Well, let me say before Carlos asks his question. So that's really where I wanted to go with the thing with Charlie. And there is no process which is guaranteed to produce success. And you know, the last memo quoted from Annie Duke's book, Thinking in Bets. Annie was a Penn, almost PhD student in psychology who left Penn to become a poker player and became the world's leading female poker player, won the World Series of Poker. And
she's back, by the way.
She's back?
Yeah, yep.
Millions of dollars. It was reading her book, Thinking in Bets, that inspired me to write my one on gambling. And two great quotes. Number one, that having a good decision process increases your chances of success, but it doesn't guarantee them. You will fail sometime. And number two, experts only make better guesses. And in your career, you're not going to hear the word guess very often, because most people don't like to admit that they're guessing. But that's what we're doing. Then they say estimate, projection, prognostication, and all those things, but they're really guessing. And all we have to fall back on is judgment. And in the long run, it's the person who has better judgment who will succeed. So sorry to make you wait, Carlos.
Yeah, don't worry. Thank you so much for coming to campus. So you mentioned in one of your memos that one of the sources of risk is model risk, or relying too much on a model for making decisions that you wouldn't usually do if you relied on qualitative judgment. So my question is, how do you develop and how do you rely on qualitative judgment to make an investment decision?
Great. Well, look, there's a million great quotes on the subject. Albert Einstein said, "Not everything that counts can be counted, and not everything that can be counted counts." And the way I say it, I'd rather be approximately right than precisely wrong. And models have the advantage of producing precision. They give you answers. You put numbers in, they give you numbers out. Where did the numbers come from that you put in? And by definition, if they don't require judgment, then they can't be the route to excellence. So it all comes back to judgment. And, people like to use models because it gives the impression of precision, dependability, rigor, but largely it's illusory. And you remember, well, maybe you don't remember, but when I was here, we used to say garbage in, garbage out.
You go.
And that's really what it is on models. So, and by the way, here's another thing to think of. If there's a model and it works, a model that doesn't require judgment, you can take broadly available information, plug your information into a model, and you'll get an answer that makes you rich, allows you to outperform the other investors. By definition, everybody will figure it out, and everybody eventually will have the same model and the same results. So it always, superior results, even to the extent that the market has inefficiencies, even to the extent that superior results can be achieved, it will always be, in my opinion, the result of superior judgment. Now, you may say, look at Renaissance. If anybody here know about Renaissance, Renaissance is a algorithmic fund that was formed by a guy named James Simons, who was a math professor at Stony Brook University in Long Island, New York, and he's a lover of astronomy. He actually has a star named after him because he supported astronomical research. And he developed this company called Renaissance, which runs on algorithms. And maybe it's produced 30% return a year for 30 years. And they charge their clients, to the extent they have clients, they keep throwing their clients out because the inefficiencies they find are not so big as to be able to invest much money. So as their clients get richer, they have to throw them out so that they don't crowd up the inefficiencies. But I mean, and I think they charge the clients 50%
4 and 44. Yeah.
profit share, or 44?
4 and 44.
Yeah, 4% management fee and 40% of the profit, and they still get clients. Yeah. They're fabulous. And I read in the paper yesterday that, Tesla has made this huge move in the last couple of months from here to here, and they had a big position in Tesla. Now, how the hell did you have an algorithm that told you that Tesla was going to succeed at making all-electric cars? But nevertheless, they did. Okay, so then you say, but look, here's an algorithmic organization that has a process, and it works. It makes them rich. So doesn't that counter what I just said, that you can't have a process? And my mother used to say, it's the exception that proves the rule. Now, what the hell does that mean? It's the exception that proves the rule. And it took me a long time to figure out what my mother meant. And what she meant was the fact that Renaissance is so exceptional proves that the rule is essentially correct. A rule doesn't mean there can't be any exceptions. So the rule is the process doesn't work, algorithms don't work, there is one that worked. Its exceptionality proves the rule. So, the point is there's only one Renaissance, and maybe 2 Sigma, or is that the name of it?
Yeah,
right?
there are a couple other quants.
Yeah, there are a couple, but
dozens.
why aren't there 100 or 1,000? Wharton's graduated a couple thousand people in the last 10 years. Why aren't there thousands of Renaissances? And the answer is that whoever built Renaissance's algorithm had what? better judgment.
That led to the model.
Yeah, right.
So all models are wrong by definition, but it takes a model to beat a model, right? We have to rely on something.
Well, you have to have a thought process. You have to have some rigor.
Is there anything in the future that will be non-quant purely?
Well, you need imagination, and so there's a lot of quantification going on in the investment business. And about three-ish years ago, I wrote a memo called "Investing Without People," and I talked about index and passive investing, algorithmic and systematic investing, AI and machine learning, and which is just a progression toward the elimination of people from the investment process. But and the reason that when I went to Chicago, the professors taught us that on average most people do average, but it happens that because of transaction costs and human error, the average investor does a little less than average before fees and then charges fees. So the average mutual fund was much less good than in just throwing darts at the newspaper. And in fact, what did they say? They said somebody should start a fund that buys a little bit of each stock in the index. Now, we didn't have index funds. We didn't have the concept of index investing, but somebody thought he didn't even know what he was thinking of. And as I said, I got out of there in '69. And '74, Jack Bogle started the first index fund that gained industrial scale. And why? And now in the mutual fund industry, index and passive investing is the majority of mutual fund equity capital. Why? Why has it been so successful in taking over passive investing from active investing? And the answer is not that it's done so well, it's that active was so poor. And guess what? The business model of active turned out to be that we'll give you subpar performance and we'll charge you a lot for it. And you don't have to go to Wharton to know that that's not a good business model. Now, it happened to take 50 years for the passive to take over the majority of the capital from the active, but it has. So the next question is, can passive take over all of it? And can it take over every sector? And I say in the memo, passive, what can a computer do? It can handle a lot of information. It can handle it fast. It can do it without computational error, and it can do it without emotional error. And that's a pretty good list. But can it do everything? I like to believe it can't, because I want to keep coming here and have you sit in the seats. But, what I say in the memo is, can a computer sit down with an executive and figure out if he's Steve Jobs? Can a computer sit down and read 5 business plans and figure out which one is Amazon? And I don't think so. So I believe, and those are exaggerated examples, and can a computer look at a bankruptcy reorganization process and predict how it's going to come out? I don't think so. And so I think that the areas of the market which are so efficient as that most bargains are either driven out or minute, in those areas, the computer, which works cheap, will probably do a better job than the humans who want to charge high fees.
But isn't that range growing? Right? Vanguard just announced that they're moving into private equity.
Well, but my guess is they're not moving into private equity on a passive, algorithmic way. Vanguard was.
But they're taking the fees out of it.
Well, Vanguard is a nonprofit organization.
Factually, absolutely true.
None of these people want to work in a nonprofit environment. But I mean, look.
Chief Investment Officer was our student.
I owe it to you to be honest. So I was giving a presentation down in Florida last January, And somebody in the audience who was probably the grandmother of a Wharton student said, what advice do you have for somebody who's considering going to the investment business? And I said, my recommendation is to do it in 1968. I mean, the truth of the matter is that the game has gotten harder in answer to your question. They used to be giving money away. They used to say, no, that's profitable, but I wouldn't touch it. And now everybody will do everything where they can make a buck. So it's clearly, I mean, it's a harder game today. Your competitors are better, and your competitors know more. And nobody should expect that the experience of the investment management business of the last 50 years will be the same in the next 50.
We're going to open it up for your questions. So I think, Farah, you have the microphone,
Right here.
And I hope some folks start asking about the politics. So we're going to. It's a good season.
If anybody
to do
wants
so.
to know who to vote for, just ask me.
Farah, maybe right here in the middle. What's your name?
I can hear. I'll repeat it.
What's
Go
your
ahead.
name? But say your name first.
Oh,
Graham. Okay.
So as you're thinking about you benefit from down cycles, so
Yeah.
how are you thinking about, what are you paying attention to that might cause a dip that doesn't just revert back up?
Yeah.
Where do you think this is going to
Okay. So Oaktree makes a lot of money from dips. What is it that might cause a serious dip, which is better known as a recession or a market, a bear market? And we're in that, as I said, the longer the upcycle goes on, the more people think it'll go on forever. We're in that difficult part of the cycle where nobody can figure it out. And everybody says to me, I know it can't go on forever, but I can't think of anything that'll make it stop, right? And that's what Graham says. And the point is, well, what could it be? It could be inflation, deflation, or a spike in interest rates. But everybody says, yeah, but I don't see those things happening because there's no sign of inflation. You can't predict deflation, and it looks like rates are going to be lower for longer. And by the way, the Fed is going to keep them down at all costs. So none of those are going to happen. And then it's hard. Then you say, well, maybe it'd be geopolitical. Well, the market team shrug off geopolitics. And then I don't think I want to go into politics quite yet. But, we could have a president who's bad for the system. But then they say, but he can't get his programs enacted. So, it's very difficult. And, I wrote a memo back in July 2007 called It's All Good. And I was bemoaning the fact that every market in every country was going up at the same time in the face of a lot of what I thought was uncertainty. And that was about a month before the onset of the global financial crisis. And by the way, 15 days later, I won one called Now It's All Good with a question mark. And then 2 months later, one that was entitled Now It's All Bad. But in that memo, It's All Good, I said, look, people are underestimating the likelihood that something goes wrong. It could be $100 oil. At that point, oil hadn't passed on. It could be pressure on the dollar. It could be a spike in interest rates, and maybe. And then I said, or it could be something else. The point is we don't always know. And, that was 2007. The spark for the global financial crisis was a meltdown in subprime mortgages. And if you Google, if in 2006 you would have Googled subprime mortgages, you would have found almost nothing written about it. Nobody sensed that this thing that was going on in this obscure corner of the markets could bring down the financial system. So we don't always appreciate what the catalyst could be. And if you look at 2000, which was the bursting of the TMT bubble, even with the benefit of hindsight, you can't find the catalyst. You cannot find the thing that made the market collapse, and it did. So all I would say is the longer the rise has taken, the higher we are, the more precarious. All I know is we're more exposed to downside. I can't tell you what will cause it, and I absolutely can't tell you when. But that's the limit. I hear about people saying, well, when is the next recession coming? Is it coming in 21? Is it coming in 22? And I'll tell you right now, there is zero grounds for making that decision. Nobody knows. On the other hand, here we are in 2020, February. In your portfolio, should you have your normal risk, more risk, or less risk? That's what we can make judgments about. And I think that for a variety of reasons, you should have less risk in your portfolio and not more. This is not the time to be aggressive, in my opinion. It's the time for defense.
But that comes at a serious cost. We have
Yes,
low yields, negative real yields,
we've been
nominal yields in
defensive.
some countries.
We've been defensive for the last 8 years. Our high-yield bond portfolios have performed 45 basis points less than the index. That's the cost of safety. You know, now, this goes back to the gambling thing. Was it a good decision to be defensive 8 years ago, or was it a bad decision because we underperformed, or was it a good decision that didn't work? And that's what that memo is all about, that there are good decisions that don't work, there are bad decisions that work. You can't tell the quality of a decision maker from one outcome, because that's the sample. You have to see the universe. You have to see somebody's decisions, in a lot of cases, over a period of time.
Okay, excellent. Should we take another, Howard?
Well,
You can choose.
Yeah.
Hello, Mr. Marks. It's quite a pleasure. I'm actually not from Penn. I came from Princeton.
Oh,
What, I'm sorry, you came from where?
Princeton.
I've never heard of it.
Yeah.
It's a great honor.
Okay.
So I was wondering, like, you've talked about central banks, Federal Reserve's policies in your memos. This time is different and mysterious. I was wondering, do you still think that they're trying to contain some of their ammunition, especially when the Fed minister released today? They're probably going to hold it for a little bit. And what is the long-term consequence of giving the markets what they need?
Fed behavior. It's the normal investor reaction is that lower interest rates are better because they stimulate the economy, and the reduced discounting factor increases the discounted present value of future cash flows. Everybody wants to see lower interest rates. The problem is that when the Fed lowers interest rates during prosperity, which is what they've been doing, they spend their ammunition to fight recession. And the short-term interest rate is now about 150 basis points, 1.5%. And the normal course of interest rate reductions to fight recession is 5%. Well, if the interest rate is 1.5%, you can't cut it 5%. And that means, and by the way, they insist they're not going to go into negative territory. That means that the Fed is nearly out of bullets. And, I don't believe that the Fed should be trying to prevent every recession. I believe that, I wrote a memo called On the Other Hand this summer, and I said, would you rather have a recession occur naturally, or would you rather prevent it unnaturally? And I believe in the natural aspect of ups and downs, and I would, if I was running the Fed, which I don't see myself as doing at present, I would allow it to happen. But I had dinner with I went to a dinner with a Fed bank president last week, and he said, well, but our job is to create jobs. And my response is, not every year. I met with another Fed president who said our job is to create economic growth and jobs over time. And over time doesn't mean every day or every year. And I think, look, most of us are here because we believe in the capitalist system. We believe in the free market. We believe the free market is the best allocator of resources. And if that's true, then why should the central bank continuously administer the price of money? And I believe that the central bank should have a very strong preference for getting out of that business.
How we're approaching the end of our time. It looks like we're undergoing an ever-evolving and interesting political cycle. Do you want to say anything about what your view of how this is looking? The odds are changing. The futures prices for the election are are volatile. What's your view?
Well, I would just look, ostensibly, you're, as I said a minute ago, you're here and you're in Wharton and you're listening to me because you believe in the free market system, you believe in capitalism, you believe in private enterprise. And, we have some candidates who don't. And I would just, and by the way, I'm told that a small majority of people, of Americans 18 to 34, think that socialism sounds like a pretty good idea. Now, I think if you asked them what is socialism, they couldn't answer. And what they would probably say, oh, that's the thing where you get the free stuff. You get the free college education and the free health care. But what I would ask anybody who's thinking about this, I would ask them this. America has been preeminent in the world for about 90 years. What is it that has created America's preeminence? And clearly our economy has been, I would say, the best functioning economy in the world for the last 90 years. Why? And our standard of living is very high, thanks to the good functioning of the economy. Why? And my answer is, it's not because we're better people. It's not because we're smarter. It's not because we're more virtuous. It's not because we're more deserving. I think that America's success and our standard of living owes to capitalism and the incentives that the free market system provides. And when you talk about limiting incomes by taxing high incomes at punitive or confiscatory rates, I think that the people who are in favor of that don't understand how the system works or how we got here. Or some people might say, well, you know, the capitalist system and the free enterprise system was great in the past, and it got us to where we are. We don't need it anymore because we're the wealthiest country in the world. But it's not going to stay that way for long if we eliminate it. And what I would merely say in closing, I'll quote Winston Churchill, who said that the inherent vice of capitalism is the unequal sharing of benefits, and the inherent virtue of socialism is the equal sharing of misery. And he always had a great turn of phrase, but I really think Churchill had it right, and I think that this is a crucial election. So thank you all for being here, and I'll be back.
Howard Marks, thank you so much.
Thank you. That was a lot of fun. Great.